Futures contracts and forward contracts are agreements to buy or sell an underlying asset at a specific price on a specific date in the future. These agreements allow buyers and sellers to lock in prices for physical transactions to mitigate the risk of price movement for the underlying asset through the date of delivery. Historically, individual buyers and sellers of forward contracts set the terms of delivery and payment for seasonal agricultural commodities. The agricultural futures market came into prominence in the mid-19th century as increasingly sophisticated modes of production, communication, and commerce necessitated a highly efficient risk management mechanism for traders and other market participants. The exchange served this function, providing a centralized venue for hedgers and speculators to buy and sell futures contracts and, most importantly, to have these transactions cleared. Unlike forwards, which continue to be negotiated between two individuals, futures are traded on an open market, anonymously, with equal price transparency for all participants. In modern times, futures have expanded to encompass asset classes such as equities, energy, foreign exchange, metals, interest rates, housing, and even weather. Today, traders can use futures contracts to directly participate in a market move without having any need for the physical commodity itself. Traders can hold their positions for various lengths of time, ranging from less than a day to weeks to months or even longer. Consider the following differences between futures contracts and forward contracts to see the advantages that futures contracts provide traders and other market participants. A forward contract is privately negotiated, non-transferable, has customized terms, carries credit default risk since it is privately negotiated, is fully dependent on the counterparty for payment, and is not regulated. A futures contract, however, is negotiated in the public market, on an exchange, is actively traded, is standardized, having an exchange-specified contract unit, expiration, tick size, and notional value, is regulated and has no counterparty risk, since payment is guaranteed by the exchange clearinghouse. What once was an agricultural exchange has grown, allowing traders access to many unique markets like interest rate futures, sector-specific contracts, foreign currency contracts, and more. These trading opportunities are only offered through the futures exchange, and now with the addition of trades using options on futures, 2 expiries per week, even more strategies and products are now available, leading to continued popularity for individual and institutional traders alike.